I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Getting Started in Technical Analysis by Jack Schwager is a great book for beginners who want to learn about technical analysis. It's a practical and straightforward guide that covers all the basics of technical analysis, including chart patterns, indicators, and oscillators. The book begins by introducing the reader to the basic concepts of technical analysis and explaining how it differs from fundamental analysis. Schwager then goes on to discuss the various chart patterns that technical analysts use to predict price movements. He covers the most commonly used patterns, such as head and shoulders, triangles, and double tops and bottoms, and explains how to identify them on a chart. Next, Schwager delves into the world of technical indicators, which are mathematical calculations based on price and volume data. He explains how to use popular indicators like moving averages, relative strength index, RSI, and stochastics, and how to interpret their signals. He also explains how to use multiple indicators together to generate more accurate signals. The book also covers oscillators, which are a type of indicator that measures momentum. Schwager explains how to use oscillators like the moving average convergence divergence, MACD, the rate of change, ROC, and the momentum indicator, and how to interpret their signals. Throughout the book, Schwager provides real-world examples and case studies to illustrate the concepts he's discussing. He also includes helpful tips and tricks for using technical analysis effectively, such as how to set up charts and how to use trend lines. One of the best things about this book is that it's written in an easy-to-understand language that even a novice can follow. Schwager avoids using technical jargon and explains concepts in a clear and concise manner. The book also includes plenty of charts and illustrations to help the reader visualize the concepts being discussed. In conclusion, if you're new to technical analysis and want to learn the basics, Getting Started in Technical Analysis by Jack Schwager is a great place to start. It's a practical guide that covers all the essential concepts in an easy-to-understand manner, making it an ideal resource for anyone interested in trading the financial markets. Point 1 states that technical analysis is a method of analyzing financial markets by studying price charts and other market data to identify trends and patterns. This means that technical analysts use past price and volume data to make predictions about future market movements. They believe that the market's price action reflects all the relevant information about a security, and that patterns in the price data can provide clues about future price movements. Technical analysts use a variety of tools to analyze market data, including chart patterns, indicators, and oscillators. Chart patterns are visual patterns on a price chart that technical analysts use to predict future price movements. Indicators are mathematical calculations based on price and volume data that are used to identify overbought or oversold conditions, trend strength, and other market characteristics. Oscillators are a type of indicator that measures momentum and can be used to identify turning points in the market. Technical analysis can be used on any financial market, including stocks, bonds, currencies, and commodities. Some technical analysts specialize in one particular market, while others apply their analysis across multiple markets. Technical analysis is popular among short-term traders, who use it to identify short-term trends and make trading decisions based on those trends. While technical analysis has its critics, many traders find it to be a useful tool for predicting market movements. However, it's important to note that technical analysis is not a foolproof method for predicting market movements. There are many factors that can affect the price of a security, including economic data, geopolitical events, and company news. Technical analysis should be used in conjunction with other forms of analysis, such as fundamental analysis, to get a more complete picture of the market. Point 2 states that technical analysis differs from fundamental analysis, which involves analyzing a company's financial statements, industry trends, and other qualitative factors. Fundamental analysts believe that a company's intrinsic value is reflected in its financial statements, and they use this information to make investment decisions. On the other hand, technical analysts believe that market prices reflect all the relevant information about a security, and that patterns in the price data can provide clues about future price movements. They do not consider qualitative factors, such as a company's financial statements or industry trends, when making trading decisions. While the two approaches are different, they are not mutually exclusive. Some traders use both technical and fundamental analysis to make investment decisions. For example, a trader might use technical analysis to identify short-term trends in the market and make short-term trades, while using fundamental analysis to identify undervalued companies for long-term investment. One advantage of technical analysis is that it is more objective than fundamental analysis. Technical analysts rely on concrete data such as price and volume, which are less subjective than qualitative factors like a company's management team or industry trends. This can make it easier for traders to make decisions based on technical analysis, as there is less room for interpretation. However, one disadvantage of technical analysis is that it can be less accurate than fundamental analysis in certain situations. For example, if a company's financial statements reveal that it is undervalued, this information may not be reflected in the stock's price. In this case, a fundamental analyst may be able to identify a buying opportunity that a technical analyst might miss. In conclusion, while technical analysis and fundamental analysis are different approaches to analyzing the markets, they are not mutually exclusive. Traders can use both approaches to make informed investment decisions. Technical analysis can be a useful tool for identifying short-term trends in the market, but it should be used in conjunction with other forms of analysis, such as fundamental analysis, to get a more complete picture of the market. Point 3 states that chart patterns are a common tool used in technical analysis to predict price movements. Chart patterns are visual patterns that appear on price charts, and technical analysts use them to identify potential trends in the market. There are two types of chart patterns: continuation patterns and reversal patterns. Continuation patterns are patterns that indicate a temporary pause in a prevailing trend, followed by a continuation of that trend. Common continuation patterns include triangles, flags, and pennants. Triangles are formed when the price range narrows over time, while flags and pennants are formed when the price consolidates after a strong trend. Reversal patterns are patterns that indicate a change in the direction of the prevailing trend. Common reversal patterns include head and shoulders, double tops and bottoms, and island reversals. Head and shoulders patterns are formed when the price makes three peaks, with the middle peak being higher than the other two. Double tops and bottoms are formed when the price makes two peaks or valleys at the same price level. Technical analysts use chart patterns to identify potential buying and selling opportunities in the market. For example, if a stock has formed a head and shoulders pattern, this may be an indication that the price is about to reverse and move lower. A technical analyst might use this pattern as a signal to sell the stock. However, it's important to note that chart patterns are not foolproof indicators of future price movements. There is always a risk that the pattern will not play out as expected, or that other factors will come into play that affect the price of the security. Chart patterns should be used in conjunction with other forms of analysis, such as technical indicators and fundamental analysis, to make informed trading decisions. In conclusion, chart patterns are a useful tool for technical analysts to identify potential trends in the market. They can be used to identify potential buying and selling opportunities, but should be used in conjunction with other forms of analysis to make informed trading decisions. Point 4 states that technical indicators are mathematical calculations based on price and volume data. Technical indicators are used to identify overbought or oversold conditions, trend strength, and other market characteristics. There are many different types of technical indicators, each with its own set of calculations and rules. Moving averages are one of the most commonly used technical indicators. A moving average is a line that shows the average price of a security over a certain period of time. For example, a 50-day moving average shows the average price of a security over the past 50 trading days. Moving averages are used to identify the direction of the trend and to identify potential buying and selling opportunities. Relative Strength Index, RSI, is another popular technical indicator. RSI is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100, with readings above 70 indicating overbought conditions and readings below 30 indicating oversold conditions. RSI is used to identify potential reversals in the market. Stochastics is another type of momentum oscillator. It measures the relationship between the closing price and the price range over a certain period of time. Stochastics oscillate between 0 and 100, with readings above 80 indicating overbought conditions and readings below 20 indicating oversold conditions. Stochastics are used to identify potential buying and selling opportunities. Other types of technical indicators include moving average convergence divergence, MACD, average directional index, ADX, and Bollinger Bands. MACD is a trend-following momentum indicator that shows the relationship between two moving averages. ADX measures the strength of the trend, while Bollinger Bands show the volatility of the market. While technical indicators can be useful for identifying potential buying and selling opportunities, it's important to note that they are not perfect indicators. Traders should use technical indicators in conjunction with other forms of analysis to make informed trading decisions. Additionally, traders should be aware of the limitations of technical indicators and should not rely on them exclusively to make trading decisions. In conclusion, technical indicators are mathematical calculations based on price and volume data. They are used to identify potential buying and selling opportunities, trend strength, and other market characteristics. While technical indicators can be useful, traders should use them in conjunction with other forms of analysis and be aware of their limitations. Point 5 states that oscillators are a type of technical indicator that measure momentum. Oscillators are used to identify potential turning points in the market where the momentum of a security is changing direction. There are many different types of oscillators, each with its own set of calculations and rules. One of the most popular oscillators is the moving average convergence divergence, MACD. MACD is a trend-following momentum indicator that shows the relationship between two moving averages. The MACD line is calculated by subtracting the 26-day exponential moving average, EMA, from the 12-day EMA. A signal line is then created by calculating a 9-day EMA of the MACD line. When the MACD line crosses above the signal line, it's considered a bullish signal, while a bearish signal is generated when the MACD line crosses below the signal line. The rate of change, ROC, is another type of oscillator that measures momentum. ROC calculates the percentage change in price over a certain period of time. It's used to identify potential overbought or oversold conditions, as well as potential turning points in the market. The momentum indicator is another type of oscillator that measures the rate of change in price. It's calculated by subtracting the closing price from the closing price n periods ago. A positive reading indicates bullish momentum, while a negative reading indicates bearish momentum. While oscillators can be useful for identifying potential turning points in the market, it's important to note that they are not perfect indicators. Traders should use oscillators in conjunction with other forms of analysis to make informed trading decisions. Additionally, traders should be aware of the limitations of oscillators and should not rely on them exclusively to make trading decisions. In conclusion, oscillators are a type of technical indicator that measure momentum. They are used to identify potential turning points in the market where the momentum of a security is changing direction. While oscillators can be useful, traders should use them in conjunction with other forms of analysis and be aware of their limitations. Point 6 states that technical analysis can be used on any financial market, including stocks, bonds, currencies, and commodities. Technical analysts believe that the price and volume data of any market reflect all relevant information about that market, and that patterns and trends in this data can be used to make predictions about future price movements. For example, technical analysts might use chart patterns and technical indicators to analyze the price data of a stock market index like the S&P 500. They might look for patterns like head and shoulders, double tops and bottoms, or trend lines to identify potential turning points in the market. They might also use technical indicators like moving averages or relative strength index, RSI, to identify overbought or oversold conditions in the market. Similarly, technical analysts might use technical analysis to analyze the price data of a currency pair like euro to US dollar. They might look for chart patterns like triangles or channels to identify potential trends in the market, or they might use technical indicators like moving averages or stochastic oscillators to identify potential buying or selling opportunities. In the commodity markets, technical analysts might use technical analysis to analyze the price data of commodities like gold or oil. They might look for patterns like cup and handle or triangles to identify potential trends in the market, or they might use technical indicators like MACD or Bollinger Bands to identify potential turning points in the market. While technical analysis can be used on any financial market, it's important to note that the same technical indicators or chart patterns might not work equally well on different markets. Each market has its own unique characteristics, and technical analysts must take these into account when analyzing the data. In conclusion, technical analysis can be used on any financial market, including stocks, bonds, currencies, and commodities. Technical analysts use price and volume data to identify patterns and trends that can be used to make predictions about future price movements. While technical analysis can be a useful tool for analyzing any market, it's important to tailor the analysis to the specific characteristics of that market. Point 7 states that multiple indicators can be used together to generate more accurate signals. Technical analysts often use a combination of technical indicators and chart patterns to identify potential buying and selling opportunities in the market. By using multiple indicators, traders can confirm signals and reduce the risk of false signals. For example, a trader might use a moving average crossover and an RSI reading to enter and exit trades. A moving average crossover occurs when a short-term moving average crosses above or below a longer-term moving average. When the short-term moving average crosses above the long-term moving average, it's considered a bullish signal, while a bearish signal is generated when the short-term moving average crosses below the long-term moving average. The RSI indicator is used to identify overbought or oversold conditions in the market. When the RSI reading is above 70, it's considered overbought, while a reading below 30 is considered oversold. Traders can use the RSI reading in conjunction with the moving average crossover to confirm signals and reduce the risk of false signals. Another example of using multiple indicators is combining the MACD and Bollinger Bands. The MACD is used to identify potential trend reversals, while Bollinger Bands show the volatility of the market. When the price of a security reaches the upper or lower band, it's considered overbought or oversold, respectively. Traders can use the MACD to confirm signals generated by the Bollinger Bands and reduce the risk of false signals. While using multiple indicators can be useful, it's important to avoid overcomplicating the analysis. Traders should only use indicators that are relevant to the specific market being analyzed, and they should ensure that the indicators are not providing conflicting signals. In conclusion, using multiple indicators can be a useful way to confirm signals and reduce the risk of false signals in technical analysis. Traders can use a combination of technical indicators and chart patterns to identify potential buying and selling opportunities in the market. However, Traders should be careful not to overcomplicate the analysis and should ensure that the indicators are not providing conflicting signals. Point 8 states that risk management is an important aspect of technical analysis. Technical analysts use risk management strategies to manage the risk of losses and protect their capital. Risk management involves setting stop-loss orders, using position sizing, and diversifying the portfolio. Stop-loss orders are orders placed to sell a security at a certain price. They are used to limit potential losses in case the market moves against the trader's position. For example, if a trader buys a stock at $50, they might set a stop-loss order at $48. If the stock price drops to $48, the stop-loss order will trigger, and the trader will sell the stock at that price. Position sizing is another risk management strategy used in technical analysis. Position sizing involves determining how much of the trader's capital to allocate to each trade. Traders might use a percentage of their capital, or a fixed dollar amount to determine their position size. By limiting the size of their positions, traders can limit their potential losses and protect their capital. Diversification is also an important aspect of risk management. Diversification involves spreading out the trader's capital across multiple markets, sectors, or asset classes. By diversifying their portfolio, traders can reduce the risk of losses caused by a single market or security. For example, a trader might invest in a mix of stocks, bonds, and commodities to diversify their portfolio. While risk management is an important aspect of technical analysis, it's important to note that no risk management strategy can completely eliminate the risk of losses. Traders should be prepared to accept losses as a normal part of trading and should not risk more capital than they can afford to lose. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.